Have you ever looked at your health insurance premium and asked yourself a simple question? What am I actually paying for if I rarely use healthcare at all? Just practically speaking, month after month, the payment goes out, your routine stays the same, and nothing about your health really changes, yet the cost keeps rising. For many households, that question comes up when a plan renews or premium jumps again. You're still working, the kids are still healthy, you go to the doctor occasionally, and yet the monthly cost feels disconnected from how healthcare actually shows up in your day to day life. That's usually when people start looking into health shares and wondering how they work and where the money difference really comes from. Before talking about savings, it's really important to be very clear about what a health share is and what it is not. A health share is not health insurance. There is no insurance company assuming risk in exchange for a premium, and there is no insurance contract guaranteeing payment. Health shares are membership-based programs where members contribute a monthly share, and eligible medical expenses are shared among the community according to published guidelines. That distinction matters because health shares do not operate with the same legal guarantees as insurance. Sharing is not automatic and it is not unlimited. Requests are evaluated based on the health shares guidelines, and there could be exclusions, limits, or circumstances where expenses are not shared. Pre-existing conditions are often not shareable for a defined period of time, which can range from 1 year to several years depending on the organization. The way health shares are treated also varies by state. In many states, they are exempt from insurance regulation, while other states require specific disclosures, issue consumer warnings, or impose penalties or requirements tied to carrying traditional health insurance. Because of that variability, it's important to check your state's insurance department or regulatory guidance before considering a health share. That's especially relevant in states that maintain individual coverage mandates. One of the most common points of confusion comes from trying to compare health shares to insurance using insurance terminology. Health shares do not have deductibles or coinsurance. Instead, most are using something called an initial unshareable amount, often referred to as an IUA. This is the portion of a medical need that the member is responsible for before sharing applies. While that may sound similar to a deductible at first, it behaves very differently in practice. An IUA is typically tied to a specific medical need or event rather than a calendar year. Once it is satisfied for that need, additional eligible expenses related to that same situation are generally shared without an ongoing percentage that keeps stacking as bills increase. To see why that difference matters, consider a very ordinary scenario. Two people experience a slip and fall accident. Same injury, same circumstances. Both break an arm and require surgery. They receive similar imaging, anesthesia, orthopedic care, and follow-up treatment. The total billed cost for each of them comes out to $25,000. The first person has traditional health insurance with a $5,000 deductible and 20% coinsurance after the deductible is met. The second person is part of a health share with a $1,000 initial unshareable amount. On the insurance side, the costs don't stop at the deductible. The individual pays the first $5,000 out of pocket. That leaves $20,000 remaining. With 20% coinsurance, they are responsible for another $4,000. That brings the total out-of-pocket cost for this event to $9,000, assuming no other plan limits are reached first. Many insurance plans do have an annual out-of-pocket maximum, which can cap total responsibility. Depending on the plan, that cap could be lower or higher than this example. The key point is that coinsurance applies after the deductible and continues to accumulate as bills grow, which is something people often underestimate when evaluating risk. On the health share side, The broken arm and surgery are treated as a single medical need. The member pays the $1,000 initial unshareable amount. After that, eligible expenses related to the same event are typically shared according to the Healthshares guidelines. There is no coinsurance percentage continuing to add cost as the total bill increases. Eligibility for sharing typically requires expenses to meet specific criteria, such as being medically necessary, provided by licensed providers, and not related to excluded services. Those guidelines vary by organization and are an important part of understanding how a particular health share operates. For larger events like surgeries or hospital stays, many health shares will also coordinate directly with hospitals or providers once the initial unshareable amount has been met. That coordination can include negotiated pricing and direct payment arrangements depending on the organization. This varies by health share, but when it is available, it can simplify the process for the member during recovery. Reimbursement or payment timelines can also vary and may take longer than traditional insurance claims depending on the situation. This structure is where predictability comes in. With insurance, your responsibility can continue to grow as costs grow until a plan limit is reached. With a health share, your responsibility for a given medical need is usually defined early, subject to guidelines and eligibility rather than expanding with every additional bill. That predictability is one of the reasons health shares can save a lot of money for healthy families. Most of the time, nothing unusual happens. People go years without major medical events. When something does happen, the difference between an ongoing percentage and a defined initial responsibility can be very significant. Another area where savings often appear is in how care is paid for day to day. Many HealthShare members pay providers directly, often at self-pay or cash rates, and then submit those expenses for sharing or reimbursement where applicable. Cash pricing in healthcare is frequently much lower than insurance-based pricing, especially for labs, imaging, urgent care visits, and some procedures. Over time, those lower prices matter. A household that uses healthcare occasionally, pays cash for routine services, and avoids high monthly premiums may spend substantially less overall than a traditional insurance plan. That does not mean this works for everyone, but it can be effective for people whose healthcare usage is relatively low. It's also important to recognize that health shares are not identical. Each organization has its own guidelines, eligibility rules, sharing limits, and timelines. Some are more flexible, others are more structured. Understanding how a specific health share handles medical needs, exclusions, and reimbursements is essential before joining. Health shares also tend to work best for people who are generally healthy and comfortable being more involved in their healthcare decisions. If you already ask about prices, you choose providers intentionally, and don't expect healthcare to function like a prepaid service, the model often feels intuitive. For households with ongoing or complex medical needs, traditional insurance may still be the better fit. Over longer periods, the potential savings can be meaningful. Many people notice the difference quickly when monthly costs drop. Over several years, especially when combined with cash pay strategies, those savings can really add up to tens of thousands of dollars compared to traditional insurance, depending on usage and circumstances. That has been my own experience as well. Over the past several years, using a health share and paying cash for care with reimbursement where applicable has resulted in substantial savings compared to what traditional health insurance would have cost over that same period. All of this needs to stay grounded. Health shares are not insurance. Sharing is not guaranteed, and guidelines matter. They are an alternative structure with different trade-offs, and they tend to make the most sense when insurance premiums feel very disconnected from actual usage and risk. As you think about whether a health share could work for you, the practical question is whether this structure aligns with how your household actually operates. Understanding initial unshareable amounts, how medical needs are treated as single events, the absence of coinsurance, and the role of guidelines helps you evaluate that fit clearly. A little disclaimer, we are an affiliate with Zion Healthshare, and we've included a link in the description if you want to learn more about how their program works specifically. I make videos that put these types of concepts in plain language for everybody to understand. So if this was helpful, click like or subscribe so you see future videos as they come out. Thank you for watching.